In order to achieve their objectives of combating inflation, central banks across the world, including India, have to reconcile several factors. Increasing the policy rate further to combat the inflation can increase loan costs and create liquidity problems. The world has experienced sustained policy rate hikes in recent years due to persistent inflationary pressure. As a result of recent bank failures in the US and Europe, monetary policy designers are faced with a difficult choice between price stability and financial stability. Global prices spiked following the pandemic, followed by supply shocks. The first signs of inflation were evident as early as 2021. Inflationary headwinds were recognized by central banks much later than they should have been. If we compare the actions of Reserve Bank of India with that of US Federal Reserve and European Central Bank, the rate hikes were highly synchronized across many regions, including India. The effectiveness and credibility has the front-loaded and coordinated monetary tightening exercise in combating inflationary pressure. Although consumer price inflation has softened in the latter half of 2022, it has not yet aligned with central bank targets. Based on the magnitude of the rate hike implosion relative to cumulative price surge, the extent of the fall in CPI inflation from respective peaks is broadly consistent in all three regions. Inflation expectation for the years ahead have also moderated, but they have not yet been anchored to policy goals. Despite this, today's central banks need to achieve more than just price stability is what the need of the hour. In an emerging economy like India, a further increase in policy rates presents a number of challenges which include budget sustainability at high cost of government debt despite the apparent independence of monetary and fiscal policies, which will be of a big concern. The RBI may have difficulty managing public debt smoothly. Private firms and households may encounter liquidity stress and default risks as credit growth in India remains buoyant. Hardening yield curves will increase the mark to market losses on bank investment portfolios, eroding capital adequacy and creating fragile scenario in the banking sector. For banks to continue to buy government bonds without compromising their profitability, the RBI may need to increase held to maturity limits. However, if there is no rate hike, the rupee's depreciation may hurt capital flows, while costlier imports may contribute to inflation. Import volumes have declined recently, which may alleviate some of the current account deficit burden going forward. A further round of interest rate increases, if administered by central banks of major advanced economies going forward in 2023, then we can say, or we have to interpret that they remain committed first and foremost to curbing inflation. To navigate uncharted waters, the RBI had to choose between aligning with global monetary policies or disassociating from it. As it continues to be vigilant about inflationary headwinds, though it kept repo rate unchanged at its April meeting, how it is going to react in the coming days has to be seen with patience, keeping in mind the global trends. Thank you very much for your patient hearing.